Oh, he's back with the bull market.
Yeah, you're welcome. What do you want from me,
Okay.
man?
When
People think
Buffett's
people think the bull market has to end because it's been a while. It's not how it works.
People think that CVS and Walgreens have to go because they were down last year. Eh, Oh,
You got you've turned into a one-trick pony. The
too soon.
listeners are letting us know you gotta move off. Come on, man.
You know how much Seinfeld was a one-trick pony? That worked for a long time. You
Yeah,
know how much George Carlin with his seven dirty words survived?
you and Seinfeld's like the same thing. You're right.
It's the same thing
Same
again and
thing.
again and again.
Same thing. It's perfect.
Tell you though, I'm watching Curb Your Enthusiasm. Have you ever watched any of that with Larry David?
Yeah, I heard it's not wonderful.
It's rough. Ooh.
Yeah, that's what happens when you try again and again and again. But the show's wonderful. Comedic genius, that man.
It's like watching the same episode every single week, but with a different set of circumstances.
Got it. That sounds like their formula, but okay.
How it went on for 12 seasons, people enjoyed it for 12 seasons. I'm fighting through it just to make it through. So in case it comes up in conversation, I can say, I know what you're talking about. But yeesh,
Look at you. You're so committed. I love that.
put me out of my misery.
Love that. Ah, let's go. We got forward PEs at 22.3. It's too high, BH. It's too high.
Where are you? Are you looking at a chart?
Small value. Oh, I'm looking at charts all right, buddy. But my secret charts, not ones to be shared.
Charts. I see your cursor. What's it gonna be? What's gonna be there?
Similar to your take on Larry David, I will be intentionally repetitive, listener. Intentionally repetitive.
Say it again.
Intentionally repetitive. Browning.
Yeah, why don't you lead us off? Lead us to the promised land.
Here's one chart.
Start with some good news. Well, what we think could
Oh,
be.
last thing, you just cut this. This has been one of those months where your kids make you want less kids. So I've been like at 5 doctor's appointments in the past 4 days with all the children. So this morning, everyone's not sick at the moment, kind of, not really. They're on antibiotics. Um, I'm taking Eleni to school. She has picture day for Thanksgiving, picture day or fall picture day, whatever. So she's dressed all cute. Take a photo while we're driving because we're in traffic. And then 10 minutes after that photo, I look back. She's like stomach complaining. I had given her a little pen and paper to draw. She hands it back to me, and I'm like, "You're gonna vomit." She proceeded to vomit 6 times in the car in
Oh,
her car seat. So it's like a horribly violent scene. Obviously, everything's a mess. She's made all this cuteness super less cute. So I had to pivot, go to my in-laws' house, give her a quick bath, and then I had clothes Ubered from my house to meet me at her school to like do all this stuff, man. It's just you gotta learn how to dance in the rain, baby.
yeah. I mean, sometimes looking down while driving, the way you drive, make a lot of people sick.
Really? That's where you go with that? That's
It seems obvious. It's your fault, not hers.
oh. Welcome to episode 62 of Talk Your Chart. I am Marcos Segrera here with Brett Horowitz. Happy to be back after a little hiatus because of travel, probably some children's illnesses, and whatever else got in the way of filming. But we're happy to be back, Brett, and today we're starting with one of my favorite charts, um, bull
Seen it
market.
before. Seen it before.
Yeah, this is just
Preach
a
to us,
new
brother.
preaching, right? So look, this is year two. The market bottomed October 12th of 2022. A bell was not rung. It just did it, whether you liked it or not. And it is up over 60% since then. This is going back to October 14th of 2024. So we're a month after that now, and the market has been up since that past month. We also have the election uncertainty behind us. Markets don't like uncertainty, and that's what elections breed. So most likely, whoever was the winner, you were probably going to get a little bit of kind of that initial pop that comes after the election simply because uncertainty has dropped off. And then you kind of get the short-term movements that, yeah, certain sectors of the economy might benefit over short periods of time because of different policies. But really, I chalk it up more to uncertainty reduction as opposed to incredible clarity around what the markets are going to do or what policy is going to be. And so basically 2 years into this bull market, a few conversations around, hey, we've had a great run. It's probably time we're due. We're due. The bear market's around the corner. And so this chart, I think, just does a good job of letting us know when a bear market bottomed, when the bull market peaked, and then how long that period of time lasts. And look, we're 2 years in right now, and we have an average and a median since 1950 of 5 years. So this is just our way of quantifying the idea that bull markets, number one, don't just die of old age. And even if you're only looking for the old age metric, this isn't old. 2 years is still young, so there's still plenty of room to run.
Well, two things. First, number one, our esteemed colleague Flavio will take all the credit for the market bottoming 2 years ago because that's when he was hired at this firm. So he says that it's all due to him.
Wow.
Um, and I'm not going to throw too much cold water on this chart with my next chart quite yet. But clearly, yes, it's been a terrific couple years. The economy has done well, even though I know half the country doesn't feel like it did, in spite of inflation going up and in spite of some of the challenges throughout the world with wars and other things. We've had a terrific run. We'll have to see if the policies of the future president affect this at all, either positive or negative, because as you said, we have now a president, but how much of the policies will actually come into play? How much is just rhetoric? How much is used as leverage for situations? It remains to be seen whether the policies will help or hurt as we go forward. But where they're coming from is at least in a good situation to start out at.
Yeah, look at unemployment. Yeah, if you're ever if you were actually going to make good on a campaign promise of getting rid of a large percentage of the government workforce, you probably want to do it when unemployment is well under 5%. Um, Again, who the hell knows what's going to happen there? The whole line of take them seriously, not literally. We'll see how much that comes to play. Every president does this. They posture, they make promises, and they ultimately don't keep a ton of them. I don't like tariffs. No one does. But we have no idea what they're actually going to be. We can very easily point to maybe not Q4 of 2024, but maybe Q4 of 2025 could look a lot like Q4 of 2018.
Yeah, I mean, it's not like that we haven't had this president up for 4 years already. We don't know. Maybe things are a little different this time, right? And some of it can be based on, well, the economy is in a different situation, or you got thrown a curveball like COVID, or you have the war, right? You can't put into place all your policies that you talk about because of the changing situation. But, just talking about my wife this weekend, how people were actually betting on the election, right? You can bet on who the president is. You can bet on pretty much anything nowadays. And I said, you keep making these bets. Over time, you will lose. And we made the analogy before. You want to be the house. The house always wins. That's why the house is always around. That's why the house gets more and more money and builds these bigger and bigger casinos. In this case, being the house is owning the stock market because over time, you're going to do better than those couple year periods the market's down. And yes, it's painful. And yes, a 30% decline means 50% back to catch up. But the upside is so much higher than the downside and so much longer that being the house is how you win in the game.
Yeah, it just doesn't matter. Average bear market is 290 days or like 9 months. Um, but the average bull is well north of that. And the percent gain versus percent loss is just asymmetric. So go ahead. I see your next chart. Try to make me try to break me down. Use
Well,
valuations. I dare you.
yeah, I mean, it started with a very scary headline coming out a few weeks ago from Goldman Sachs. So the S&P has hit, I think, 50 all-time highs this year. I think it actually hit 50,
I think
which is
55.
great. Hmm? Even higher?
Yeah, I think so.
Even higher. Okay, so a lot of new highs this year, forgetting about the actual number. It's actually tripled over the last 10 years, but Goldman Sachs came out with a note that said, we estimate the S&P 500 will deliver an annualized return, nominal return, so that's even before inflation, of 3% over the next 10 years. Okay. What was this based on? This is based on the fact that the all the indices and the measures of the index, the price to earnings ratio, or what we have here, the cyclically adjusted price to earnings ratio by Robert Shiller, has us looking basically almost at the highest point it's been other than the dot-com bubble. And so you can't take that and say, okay, tomorrow the market's going to go fall down because it doesn't mean market's high, it just immediately collapses. There's two ways to get to back to normal. Either a big decline in the market, or B, lower returns over time that get you to the same place. But they suggest, you know, the next 10 years is going to be pretty rocky. Agree or disagree?
I think it's I think it's great for headlines. Everyone's caught this article. It's been good. I posted something about it on LinkedIn also. Um, yeah, I think that's fine. The problem with this, and Goldman said it in their article, right? I don't know if you read it. I posted. I can't pull it up fast enough, but they basically said it's really hard to make 10-year projections. And when we've done it in the past, we've been wrong a lot. So they said that, but no one read that part. Everyone just kind of reads the low returns piece. Um, I think it's completely possible. It's not going to happen in a vacuum, right? Because to get to that average, you're going to have some cataclysmic level event in the market. And cataclysmic sounds apocalyptic. That's not necessarily true. You're going to have some drawdown of 30% or so that bookends that. That the reason you get down to such a low average is because something like the lost decade happens again, where you get the start of 2000, the tech bubble, the end of the early 2000s, you get the great financial crisis, and oh, there you go, a 10-year period when the S&P literally lost money. So yeah, of course it can happen. It's just statistically, it's a low probability. Um, and then, okay, so what do I do about it? You just shouldn't care about this. If you're allocated properly, hopefully you just don't have all your money in the S&P 500.
Right.
Or hopefully you did over the last 10 years and now you're like, you know what, but now I'm going to diversify.
Well, we know that when we run our Monte Carlo projections and our financial planning tool, they build in losses. We expect losses once every 4 years. I mean, for the calendar year, and we expect losses intra-year at 14% down every year. And so these things are going to happen. There's a lot of people who are leaning more towards their camp because prices have just sort of a little bit gotten away from themselves. It doesn't mean we can't grow into those earnings. It doesn't mean we can't have great tax policy and other policies that stimulate the economy and GDP grows even faster because we do look like the best country out there compared to Europe, compared to what's happening in Asia. But I will also point out that Goldman Sachs probably has about 1,000 different economists. And so, depending on which economist you talk to, they're going to give you a different answer. So, for example, the economists of their department who projected at the end of 2023 where the S&P would be at the end of 2024, they guesstimated, let's see, where is their number? 5,100 on the S&P would be where it ended end of 2024. Right now, we're about 6,000. So they are quite a bit off on that projection. And so it could be just as much off on the next projection. No one's going to remember if they were wrong, right? That's the problem. You remember if they're right because you think they're genius, but most of the time they get these things wrong.
No. And you make your money off that one time that you were right, just like the GFC folks did. But no, yeah, it's a fun headline and fun to read. But again, the issue is read the whole paper. It's pretty interesting, and they're pretty intellectually honest about calling themselves out because no one else is kind of keeping receipts, but they are. And I've read plenty of those reports. A lot of people don't keep receipts. They make a prognostication. They're okay. Let's show me your track record, and there's no track record to be found. So
Well, my last point I'll just make is that even if you believe them or it does happen, the question is, what do you do as a result, right? You're probably not going to be dumping all your money into bonds because the stock market is performing very poorly. It probably means that real estate, other things are performing poorly. You're not going to try to time this, try to get into bonds immediately right now and risk that you're wrong and miss out on what could be big growth. So it's not like you're going to take them in their vision into the future and say, oh, they know what's going to happen and I'm going to change my entire strategy.
yeah. Look, distractions are the assassins of great work, and the great work is just investing in the innovation that is available in the global stock market, and just stock is the best way to take advantage of it. I will say though, BH, and we've had this conversation probably more academically than practically, higher valuations over the next 50 years makes sense.
With rates lower, you're saying?
Not just that, just the makeup of the companies, asset light, technologically advanced businesses.
If they have the earnings, I get it. They just have to have the earnings.
Yeah, and they
If
do,
it's
right?
if it's just smoke and hope and expectations and those don't things don't happen, then everything's overpriced.
No, it won't be hope. What's going to end up happening is they're going to overspend in this whole AI boom, and that's going to suck. They're going to get repriced, and then all that overspending will be built on and rewarded 10 years from now. Just like the last innovation cycle from the early 2000s, where the only issue there was no earnings whatsoever. But ultimately, Amazon, Google, and Microsoft and Facebook reaped the rewards of all the fiber, so to speak, that got laid in the early 2000s.
Okay, well, we'll see what happens. I got one more topic to talk about.
Okay,
And
fine.
this is something that I think gets a lot of talk with our clients when they look at other firms out there and the pitches they get. So we have here is a proposal that one of our clients got from a an unnamed firm that was pitching them on investing with them. They said, "Hey, we're going to take your money, we're going to put some in bonds, put some in different funds, put some in dividend stocks, everything that's got a nice little yield there, and we're going to charge you nothing on the bonds. And so as a
Oh,
result, your fee is going to be $19,000, and we're going to manage almost $7 million of your portfolio." How is this possible?
question.
Yeah,
Did you put this together or did the company put this together for the client?
they put it together for the client.
Okay.
So my first response, and I wrote this in an email, was not only is this completely egregious in what they're showing, but is borderline criminal to say that you're going to be trading bonds or buying all these bonds for somebody and charging nothing, right? There's no charities out there that buy bonds for free. There is a cost.
There's
And so what I wanted to share with our consumers, with our viewers, is a little snippet from the EMMA website, EMMA, which is a municipal bond website, where you can go on every single day and see bonds that are bought and sold and see their spread. So while there was no fee per se to buy that bond, you're being charged when you buy a bond higher than the price you're being selling the bond for on the same day. So in here, just as example, this is a little chart from one of the bonds as an example. And we can see here that when the customer bought the bonds on some of the lines, you were paying 113, 112, somewhere in that range. And when the customer sold the bonds on the same day, that was all in the 111 range. And so that spread between the 111 and the 112, 113 is the fee. Someone is making that fee, whether it's the broker, the company, it's going out of the customer's pocket and going to somebody else's hands. Those fees exist. You can see that. It's not that easy to find. But if you do some research, you'll know that no one is buying and selling bonds for free.
that's egregious that there's no disclosure. Was this a complete surprise?
Yeah, I don't know about surprise, but they were simply looking at their fee, looking at our fee, and saying, man, you guys are expensive compared to this. Well, of course, because more than half your money was being charged no fee.
Hmm.
So ultimately, they did not move forward with it. They probably asked some good questions, and they came back with an answer that said, yeah, there was a fee, but at first blush, that was the proposal they were given.
Oh God. I can probably guess the firm, but I'm gonna get it from you offline, obviously. What a treat. We should
Oh,
forget about all the other charts we looked at. This should be the only one, the public service announcement
but you must
around
hear it all the time, right?
the bond money that they don't charge anything on. Oof. Ladies and gentlemen, get a fiduciary between you and your portfolio.
Yeah, it's one thing if you're going to tell the truth and put it out there and say that, the fees are small or, because again, you need to get paid for your work. But it's another thing to say that I charge no fees.
Oh man. Okay. Oh, this is a good one. I can't wait to see the whole thing.
Well, if can't wait to see the broker's response when they realize that the client forwarded to us for our response, and we instantly saw that right away.
Oh my God. Yes. Okay. Um, BH, that's it, man.
That's
The
it.
bull market. It's not
Keep
old.
going. Keep
It's
going.
young.